Well, hello everyone and welcome. If you can see me, my name is Rahul and I'm the Chief Growth Officer at Property Dollar, and I'll be your host for tonight's Investors Strategy session. Now, if you're new to Property Dollar and haven't downloaded Property Dollar yet, feel free to use the link in your chat function. And if you can't see that link over there, we will post that again. And for all the Property Dollar users, welcome. We are thrilled to have you join us for what promises to be a powerful data driven dive into the questions every property investor is asking right now. Where should I invest next? And how do I know I'm not buying too late? Now, tonight's session is titled How to Use Data to Beat the Market, the science behind picking high growth suburbs before everyone else. And our speaker is someone who's not just talking about data, he's building the future of how we use it. A quick introduction to our guest. Joining us is Dr. Matt Majita, co-founder and CEO of HtAG Analytics, and one of the most respected platforms for suburb-level investments insights in Australia. Matt is obsessed with uncovering patterns in property data. He writes, speaks, and advocates for the role of machine learning and big data in demystifying property investing. And his mission is to make suburb research accessible and evidence based, not just gut feel or guesswork. Now, you have probably seen his work on LinkedIn, where he's built a loyal following, me amongst them, of investors and professionals who trust his analysis. So, tonight you'll be learning directly from the source. Now, here's how the session will run. Now, Matt will walk us through his approach, including how HtAG evaluates more than 5,000 markets across Australia. This session will run for roughly 45 minutes, followed by a live Q&A. So stick around and bring your questions. Now, you can post your questions in the chat function or the Q&A functions, which you can see at the bottom of your screen. Some quick housekeeping. Please keep your mic muted during the session. Post all your questions on the chat function. We will cover all the questions at the end of the session. And you will also see a short poll pop up on your screen. We request you to please take 30 seconds to fill it. It will help us better support you beyond this session. Now, final words before we kick off. If you have ever felt overwhelmed by conflicting advice or like you're always on one suburb late, you are at the right place. Matt is here to show you how to cut through the noise and make smart data-backed decisions that actually grow your portfolio. So with that, Matt, over to you, man.
All right. That was such a professional and kind introduction. I appreciate it, Raul. Thank you, everyone, for joining. I can't see people. Hi, everyone. I can't see your names. My name is Matt, as Raul has mentioned. Now, just a bit of, I guess, I would say context. HtAG Analytics has been a data-driven analytics platform for property investors and buyers agents for about 8 years now. We now have a team of 6 people. It's growing rapidly. It was co-founded by myself and Alex Filoseyev, who is, who I met about, let's say, 7 years ago. We wanted to build something that's going to help us essentially. And it just so worked out that it was helping other people. Now, as Raul has alluded to, I think data-driven property investing is a term that's been used a lot recently. And notions such as, machine learning and everything else does help with property investing because it allows us to look at large data sets and compress them into a single decision. However, there is one crucial aspect of property investing that we usually don't consider. I always say that property investing is a game of finance on the surface level because it involves money essentially, but it's actually on a deeper level, it's a behavioral science. So we are in the business, anyone who wants to invest in property, we should be in the business of trying to anticipate market movements. And by doing that, we actually trying to anticipate behavior the individuals exhibit when it comes to purchasing patterns. Okay. Lucky for us, property is an illiquid asset. Now, what does that mean? Illiquidity of assets is characterized by the lack of exchange between buyers and sellers. Now, when I say lack of exchange, in comparison to other asset classes such as shares and crypto, and I've traded all asset classes under the sun, if you look at a 15-minute chart for shares or crypto, you will see that, trends really shift essentially from minute to minute, So they shift sporadically. Why? Because people buy and sell instantaneously. Now, with property in Australia specifically, it is a different game because people tend to hold on to property for a long period of time. I mean, one reason is they need a roof over their head. Another reason, obviously, is, to take advantage of compounding. And because that happens, it takes a long time to buy and sell property. And this is why they call it an illiquid asset. When we buy property, it becomes very hard to extract, I guess, the gains that we make. I mean, hard in comparison to other asset classes. And this actually works to our advantage. Why does this work to our advantage? Well, simply because when you have an established trend for market dynamics, it takes a very long time to shift an emerging or enduring trend, which makes prediction very easy. Okay, so I want to really emphasize that. Predicting market movements is very easy. However, we need to employ the right methodology in order to do so. Okay, so what is the right methodology? Now, at HtAG, we have a 4-step process. It was a 3-step process before. Now it's a 4-step process. And it must begin with the individual. What we usually see online is we see, because I guess social media allows us to connect with others, but it also allows for, a multitude of voices, which sometimes in some instances, I would say inaccurate, but also incomplete. So what we see usually is we see that in the context of property investing, areas are usually promoted in and of themselves. So for example, people will come out and say, go buy in Townsville. You need to buy in Townsville. Now, why that sort of irritates me personally is that I never hear or rarely hear an area being spoken about in the context of the individual brief. So every time I hear that somebody promotes an area, I always ask, who is that area for, under what brief, for what investment time horizon, etc., etc. So every analysis that we do when it comes to property investing has to be individual specific, which is why a hotspot for me is not a hotspot for you. Okay, that's a very important notion. I mean, hotspotting or hotspot as a term, I think it has done more disadvantage to the industry than good. And I mean, hotspots do exist, but the problem with hotspots is that we inadvertently assume that that area is a great investment location for everyone, and that is not the case. Okay, so if we are starting with the individual, we need to develop a very concise way on how to capture the individual circumstance. Okay, so at HtAG, we do that through 5 simple questions. Now, those there's only 5 questions essentially, but those questions tell us a lot about where we need to look. So the first question that I always ask everyone is, what is your budget? Now, budget delineates the boundaries of possibilities. What does that mean? If you have only 350K to spend, okay, you'll be investing in areas that have certain dynamics that you have to compromise on. For example, there is a reason why a 350K area is sitting at that price range. And that manages our expectations. What do I mean by that? We cannot expect from an area that's 350K in value to deliver 15% compounded growth for the next 15 years. Okay, because there are certain economic dynamics that are impaired within that area, which is why it's sitting at 350K. So, contrary to that, area that's higher in value usually has some economic underpinning, which sort of got it there. Now, does it mean that we shouldn't invest in areas that are 350K? Absolutely not. We should invest in areas, any area for which we can afford. However, it is our responsibility to actually go through a process and to find the fastest horse. So property investing is about eliminating opportunity cost. And what is opportunity cost? Opportunity cost is the cost of investing in an inferior location for your brief. So if there are other multitude of areas that are better for you, you are increasing opportunity cost, meaning your money would have been placed better elsewhere. Okay. So this is the budget, and see how just a simple, question, what is your budget? There is a lot underpinning that question. Now, the question number 2 that I always ask is, what is your investment time horizon? If your investment time horizon is 3 years, for example, you want to enter an area, leverage the growth and sell out, you'll be looking at completely different areas to individuals whose investment time horizon is 10 years. So that inadvertently as well shapes the boundaries of possibilities and where we should be looking at, okay? And there are certain metrics and indicators that align with the short-term investment time horizon, mid-term and long-term investment time horizon. I'll explain that later. The third question we must ask, especially as individuals, because I guess property investing is about building a portfolio. It's, and I know it is difficult to get past third or fourth property, and this is where structures come into play. But if we want to or have a desire to build a portfolio to use property to sort of realize financial freedom, we have to consider our equity extraction timeframes. So putting serviceability on to the side, assuming that we have the serviceability, we should always ask ourselves, okay, when are we prepared to extract equity into the subsequent purchase? Now, that requires a serviceability element, but it also requires the area to achieve particular growth targets at certain timeframes. So at HtAG, for example, we have an equity extraction timeframe thesis for 2 years, 3 years, and 4 years. And that inadvertently also guides where you can invest. So for example, to give you an example, if you have an equity extraction timeframe of 2 years, meaning, and what I mean by equity extraction timeframe, I essentially mean a growth target of 20 to 30%. If you have an equity extraction timeframe of 2 years, i.e. a growth target of 20 to 30%, you are inadvertently bound to invest in areas that are already hotspots. Okay. And there are pros and cons to that. The pro of that is that you will, if you source an asset, be able to leverage market momentum to realize those gains at the 2-year mark. The cons of that are that it will be difficult for you to source an asset because there's a lot of competition in that. And this is the crucial element. Every area and every investment strategy has pros and cons. And we as individuals, we have to understand them so we can plan accordingly and know where we don't want to compromise on, or things that we don't want to compromise on. On the other hand, if your equity extraction time frame is 4 years, that means that you can invest in a warm spot. And warm spots are areas essentially that will become hotspots, but will take about 4 years to realize a growth target of 20 to 30%. Okay. The fourth question, and this is the question that's usually, I haven't heard it been asked in the industry, is what is your risk profile? Okay. Now, risk profile is defined in different ways by different individuals and institutions. Okay. At HtAG, risk is an impediment to our goals. And because property investing is a deterministic game, there's essentially 2 goals in property investing. There's capital growth and cash flow. Now, we can have a mixture of both, but essentially even the mixture is derived from those 2. So what are the impediments to capital growth and cash flow? We usually classify it in 2 different domains: the economic domain and the environmental domain. Now, the economic domain talks about industry diversification, exposure to mining and agriculture, while the environmental domain talks about flooding index and bushfire indexes. And usually areas that have very high industry centralization, they're extremely volatile long-term, which means that you can make substantial amount of money in the short term, but that growth gets evaporated, which inadvertently leads me to saying this. Question number 4, what is your risk profile? And question number 2, how long do you plan to hold the asset in your portfolio are tied? One implies the other. What do I mean by that? If your asset hold time frame is long-term, your risk profile should be inadvertently low, meaning you shouldn't be investing in areas that are extremely volatile. If your investment time horizon is short-term, then you can adopt more risk and potentially invest in volatile areas or areas that have centralized industries. But the onus is on you to actually time your entry in the market. And this is another thing. it is no longer about timing the market. It is also timing the market entry. And you can time the market entry because of the liquid nature of assets and because trends are semi-enduring and take a long time to change or shift. And I'll show you how that's done. Now, question number 5 is, are you in the acquisition stage, i.e. acquisition or expansion? Or are you in the consolidation stage in a portfolio building process? Now, what does that mean? We have to decide what our primary investment domain is, okay? So there's 2 primary investment domains. Again, there's capital growth and cash flow. I always say to investors, you can't have your cake and eat it too. And if you want to have your cake and eat it too, you need to understand the ramifications of that, okay? And what are the ramifications of that? Let me just highlight this. If you're investing under a balanced strategy, i.e. you want cash flow, but you also want capital growth, you should know that those areas inadvertently produce lower annual long-term averages. Why? Because the area goes through a process of capital growth where demand is focusing on purchasing. Then it goes through a process of rental increases because demand is focusing on rentals, and like that repeats itself. And because the area is not growing constantly in capital growth and goes through cycles of capital growth, rental increases, capital growth, rental increases, you're inadvertently bound to produce lower annual long-term averages. And every investor should understand that. Now, sometimes we have to invest under a balanced strategy in a sense that, you know, we have, I'm reading the comments. I'll address the comments later. Sorry, guys. So sometimes you have to invest under a balanced strategy in a sense that, you know, you need to maintain the asset, but you need to understand the ramifications of that. Okay. So question number 5, as I said before, you need to decide whether your primary investment domain is capital growth or cash flow, which will then define the significance of metrics. And this leads me to a very important notion. In property investing, we usually see people treating every metric with the same significance, with the same, and if I use a different term, with the same weighting, with the same importance. And not all metrics are created equally under the sun. And I'll give you a simple example. If you are investing under a cash flow strategy, then metrics such as vacancy rates, yield, or rental increases would have a much higher significance than some other capital growth metrics. Conversely, if you're investing under capital growth, then supply and demand will have a much higher significance than, for example, cash flow metrics. And this can become a little complex because, let's say on HtAG, now it is a little complex, but there is a method to the madness, which I'll highlight. On HtAG, we currently have 150 metrics. Now, I always say to our members, more does not mean better. The fact that I'm saying we have 150 metrics, it doesn't mean that I have a better service. However, what that means is that you can triangulate. And what does triangulation mean? It means that you can look at the same location from multiple angles. And because we have, I wouldn't say an infinite variations of brief, but we have a lot of variations of briefs because we have a lot of individual circumstances. You need to have the tools at your disposal where you can look at an area from multiple angles to determine how it's going to perform short-term, mid-term, and long-term. Okay, so this is very important. If you don't have a layered significance in metrics, a layered importance in metrics, you are actually averaging your results. If you're treating everything the same, it's like treating everything, it's like not treating anything at all. If you assign the same significance to everything, it is the same as assigning no significance to all. And the byproduct of that is increased opportunity cost, meaning your money would have been placed better elsewhere, meaning it's going to take you longer to build your portfolio. I always say to our users, in the same way that positive growth compounds over time, so does lack of growth or negative growth, which means that instead of taking you 10 years to build your portfolio, it might take you 18 because your assets were lagging. So that's what's really important. Now, regarding the method to the madness, okay? So I will show you the process that we have on the platform on how we come to locations that have an equity extraction time frame of 2 years, 3 years, 4 years, etc., and all the variations of those questions. I mean, I can't do them all because this session will last 5 hours, but I'll show you, I guess, the bedrock of what is necessary to understand. Now, before I do that, let's first highlight and speak a little bit about the hierarchy of metrics. Now, there are essential metrics. I call them macro or meta because I couldn't figure out a better word for it, I guess. And what are these metrics? These metrics are data points that need to be present nearly across every brief, okay? After we address these macro metrics, in most instances, a lot of people, when they speak about property growth or price growth in areas or appealing areas, they speak about it in the context of demand. But property investing or using data to invest in property is a process of elimination. So we address the things that we can't control first in order to reduce the uncertainty and increase the probability of a particular outcome. And this leads me to a very important notion. We never deal in certainty. There's nothing certain in this life. I don't know whether I'm going to drive out of the driveway and get hit by a car tomorrow. Who knows? A bit of a dark joke. But what I'm trying to say is that we are trying to increase the probability of a particular outcome. And we do that by layering the metrics in the appropriate way. Now, let me just show how we do that. I'll share the screen. So I hope you can see the platform here. Now, I'm not going to go into everything that's on the platform because I think it's just unnecessary for the time being. But I will speak about, given the title of the session, I will speak about 10 or 15 metrics that are necessary for you to address first to really find great investment locations for yourself that are close to guaranteeing that they will return. Now, when I say we don't deal in certainty, that's why I said close to guaranteeing that they'll return. Now, when I layer data, okay, I go as close to the purchase point as possible. I see a lot of individuals looking to invest in certain suburbs by analyzing the LGA where that suburb is located. Now, that's futile because usually data for LGAs are aggregated, which means that nuances are glossed over and leveled out, okay? So you need to go as close to the purchase point as possible. Now, when it comes to property investing and making decisions upon data, when you make a decision upon data, you require volume of information from which you can extrapolate a discernible pattern, okay? And because you need a volume of information, it is very difficult, and it's, I think, practically impossible to actually go to the street level, because on the street level, you're not going to have a sufficient volume of sales from which you can determine the typical price, the days on market, and all of these other things. You probably have one or two sales in the street that are separated by a quarter, okay? Which is why the closest point of purchase at this stage, unless something completely changes when it comes to property investing, structurally, I mean, is the suburb. So when I look at the data level is the first thing that needs to be addressed. The reason why I go as close to the purchase point as possible is by going as close as I can, increasing the probability of a particular outcome. So I need to know, at least on an aggregated way, how a suburb is performing. And by the way, there's been a plethora of research done. Usually, now coming back to the process that I said initially. So the process starts with a brief. That's the step number one. Step number two is building the filtering algorithm that relates back to the brief, that reflects the brief and our goals. Step three is a detailed comparison. And step four is inspecting the street level information to find the best asset. What I usually see is that people jump, sometimes they don't consider brief and their needs, but even if they consider the brief, they jump from the brief to the asset selection, completely disregarding the suburb. And there's been a plethora of research done in Australia, US, Canada, and China, and I think UK as well, that 80% of growth in an asset comes from the location where the asset is located, and only 20% from its characteristics, okay? So when it comes to a funnel-like approach to research, we first address all of the things that yield the highest reward, which means that we first need to determine the suburb and then go select the asset within that suburb. I always say, and pardon for profanity, I always say you can buy a shit property in a great location and you'll still see growth, okay? Now, you'll probably not see as much growth as a great asset in a great location, which is why compounding good decision-making is essential, but you will definitely see more growth from that than if you buy a great asset in a bad location, a location that doesn't have momentum. So put out of your mind completely the asset, how it looks, because that's downstream. That's a decision that rests downstream, okay? So when it comes to building the filtering algorithm, I first address the data level. I go as close to the purchase point as possible, okay? Now, when it comes to building a filtering algorithm, that's a fancy word of saying I'm building an arrangement of metrics that are connected to each other to reinforce my brief, to increase the probability that I will find a suburb that mirrors or reflects my needs, yeah? So the first thing that I address is the suburb. The second thing is the property type. Now, we have to understand that houses return more than units. Now, in some instances, you might have a very restrictive brief or not enough to spend, and you're going to be forced to look at units, okay? But in most instances, to increase the probability of growth, you need to invest in the asset type that yields you the highest reward. And this is why I choose the house. Now, there's another thing that I always do is I enable the bedroom filter. And this brings me to using data sets to find suburbs. Data sets are very monolith and inflexible structures, okay? Which is why building a collection of filters is essentially a process of eliminating noise. But we have to be very careful there. We have to tread the line finely. And what I mean by that, we have to at the same time cast a wider net to include as many options as we can, but we have to be very rigid on the filters that we must introduce, okay? I usually see people trying to introduce everything under the sun to increase the certainty. You can't do that because, for example, let's say if you set a very low stock on market, okay, in a suburb, that's 0.5%, you might find, you might have eliminated great areas that have 0.6 stock on market, okay? So that's what I mean by monolith and inflexible structures. And this leads me to another notion that's very important in property investing. Perfection does not exist. You will never find a suburb that is perfect, ever. It doesn't exist. There's always something that is wrong. There's always, let's say, in an arrangement of 30 metrics, you'll have one, such as renter to owner ratio, which is fairly high. You got to acknowledge that and have strategies on how to deal with it. And this is why, in the context of advice and guidance, I always, when I deal with clients, when I do strategy sessions, I always give my clients both pros and cons and mitigating strategies for the cons. If anyone comes to you and just tells you everything good or great about the suburb, all pros or no cons, either they don't know what they're doing or they have ulterior motives. That's very important to recognize. So the reason why I enable the bedroom filter is I need to cast a wider net. For example, I might have only 600K to spend, but for example, there is a great area that's 650, within which I can't afford a 4-bedroom house, but I might be able to afford a 3-bedroom house. And then I look at the demand profile to see whether 3 bedrooms are in demand. And if they are, I press the button. So that's why I enable the bedroom filter. Now, building the filtering algorithm, as I said, is separated into 3 different portions: macros or essential metrics, then we go into supply, then we go into market cycle delineation. Okay, and I'll explain all of these, a subset of all of these metrics. So what are macro metrics and why are they there? The first metric is data confidence. Okay, when you're making a decision upon data, you need to make sure that the data that you're looking at is accurate. And how do you derive data accuracy? You derive data accuracy by volume. The more volume of sales and transactions you have in a particular suburb, as I mentioned before, the more you can extrapolate a discernible pattern, okay, from which you can make a decision. Now, this becomes extremely important in the context of a decision that will hold the asset in the portfolio for a decade or more. Because the more we go into the future, the more uncertainty we bring upon ourselves. And if we are investing in an area that has medium or low data accuracy, we're bringing uncertainty upon ourselves, okay? So, and let me give you an example. If you have one sale today in an area and then another sale in 3 months, one was sold for 560K, the other one was sold for 780, you can't do an average because 2 is not sufficient to do an average, which means you wouldn't know what the average price is for that area, let alone everything else that's extrapolated from sales, like days of market, etc., all of the other important metrics. So if you have an investment time horizon that's long-term, even short-term and mid-term, I always make sure that the data accuracy is high, okay? The next macro metric that I always include is risk. Now on HtAG, we have what is called the RCS risk score. Now imagine, and by the way, whoever is using HtAG, and if you're servicing clients, for example, you're not going to tell your clients because the RCS score is such and such. No, let me explain what it actually underpins. So the RCS score is an algorithm that takes into account 80 indicators, but they're, as I mentioned before, mainly relegated to two different domains. And that's industry centralization or economic domain, or the environmental domain. Now, if you're holding the asset long-term, you should inadvertently have low risk, okay? Because you see a lot of areas, and this is where people approach it in the wrong way. I see some analysts actually choosing an area on the basis of medium incomes. Now, in a hierarchy of metrics, medium incomes are maybe level 3 or level 4. Why? You have a lot of suburbs in Australia that have very high medium incomes and yet have seen minus 40% negative growth in a decade. Why? Because those high incomes are mainly centralized in a single industry. And the problem with single industry is that if you hold the asset long-term, you are bound to go through at least one macroeconomic change, which is going to impact the industry in question. Okay, what is the example? Let's say I invest in a coal mine. And let's say China imposes tariffs. We can't export our coal, which means that I need to cut costs, cost of production. And it usually is manifested as letting the workforce go, reducing the workforce, which impairs the purchasing powers of residents and manifests negatively upon the area's ability to grow in value. Okay, so I always, when it comes to the risk score, I set it at greater than equal to 50. Why 50? Imagine it's a score from 1 to 100. The higher the score, the less risk. And this leads me to another also important thing. We include the metrics that we must to eliminate noise to find a shortlist, and we also need to consider the right ranges. Now, do I want the risk score to be at 95, which means practically no risk? Absolutely. But if I set it at 95, I might exclude an area that's phenomenal and that has a risk score of 94. Coming back to imperfections in data sets, that's something very important to understand, which means that I set the boundary at a level that I don't want to compromise on. And in this instance, I'm saying to the data set, eliminate all of the suburbs that have above average inherent risk. Okay. Now, the third macro metric, or the essential metric, is affordability. Okay. Now, this is a very interesting one, and one that doesn't really resonate right away in some instances, but it's extremely important. Now, the gap between wage increases and property price increases has been the widest since 1970. And not only the widest, I usually have a graph, by the way, apologies guys, I have a new laptop, so I can't actually show it now, and I can maybe distribute it to Raul and he can send it to you. You should see the graph. The disparity is huge, okay? Which inadvertently relates to, if you look around, people struggle to get onto the property ladder. Owner-occupiers are struggling to purchase property. Investors are struggling to get onto the property ladder. And this is why out of 100 briefs that I get from investors that I need to analyze, I would say 99 are for sub 600K. Because investors don't usually invest in 800 or 900K areas because of the price restrictions or the serviceability. So affordability is probably one of the most important indicators that drives purchasing patterns. And let me explain the dynamics when you think about it. And this is why I said at the beginning, data is a great tool to make a decision. But if you don't understand what each metric represents in behavioral terms, you won't be able to use it properly. So not only do you need to understand what the dynamics of each indicator, but you also need to connect every indicator into a logical narrative or a story that has an increased probability of an outcome, okay? So about the affordability index. Now, how does this work usually? If property is very affordable for its residents, usually, by the way, purchasing in a suburb starts from owner-occupiers participating in the market, usually, okay? And they can participate in the market if property is affordable. Now, other ingredients need to be present, which I'll discuss later. And when they are in unison with affordability, what happens is that small increases in demand lead to large material changes in price growth. And in that instance, this causes what in financial theory is referred to as reflexivity. And reflexivity is essentially a positive feedback loop where more growth invites more growth. And this is where investors start migrating to the market. And you need both investors and owner occupiers competing for the same asset for you to see sustained above average price growth. Okay, see how I explained the behavioral dynamics of a metric. So the affordability index on HtAG is essentially years to own. How long does it take for a medium income household to pay off a loan within a particular suburb? Now, the affordability index shifts on the basis of the price point. So years to own for price points that are below 550 should be below 35 years to own. Between 550 to 850 budget, it should be less than 40 years to own, and 850 and above, it should be 45 years to own or less. Okay. So what have we done to this at this point? We have ensured high data accuracy. We have eliminated volatility from industry centralization and higher holding costs from exposure to negative environmental effects. And we have addressed the affordability. So we are setting the scene for growth. Okay. Now, the next stage is addressing the supply. As I mentioned before, addressing the demand side of the equation first is inappropriate because demand can be manipulated. HtAG currently has 3,500 members. Now, let's say we partner with Property Dollar and, we distribute to everyone, guys, we are all going to Ballarat. Okay. That means that we will affect and shape the demand side of the equation. Okay. First, we are speculating. And that means speculation means substantial growth, but also substantial downside thereafter. But putting that aside, we're still not going to see any growth if supply is rampant, i.e. if there's too much property for sale within that market. That's why we address the supply first, because we can't control the supply. The government controls the supply. Now, at HtAG, we address supply from different temporal domains. What does that mean? I need to address the current levels of supply. I need to also peek into historical levels of supply and see whether it's trending down. I need to address short-term future supply of new dwellings, and I need to address long-term future supply of existing dwellings. And by layering the supply temporarily, I can actually then increase the probability that I will see growth at those timeframes as well. Okay. Now, on top of that, you do a sprinkle on top, a bit of seasoning, and you do that with trends. So every metric has a different temporal representation, but if you also layer trends of those metrics on top, and remember, trends in property are enduring because of illiquidity of asset, you're further compounding the good decision-making. And you are you're reaching as close to certainty as you can. So the next metric that we introduce is stock on market. That's current levels of stock for sale in a particular market. Now, what I usually set it as is less than 1.5. Do I want it to be 0.5? Absolutely. Less the better. But if I set it at 0.5, as I mentioned before, I might exclude a great area at 0.6. But the 1.5 range is what I don't want to compromise on. By the way, guys, we have a data dictionary on our platform. You can refer back to the data dictionary. Not only does it give you an explanation of metric, but it also gives you strategic guidance on how you should use it and also the ranges that you should employ. Okay. Now, the next thing that I do is remember trends. Trend is your friend in property investing. I started talking about that, but I sort of mumbled at the beginning. The reason why we started HtAG, Alex and I started investing about 20 years ago. And I remember I'm the type of guy who tries to read everything under the sun to understand the subject matter. And at that time, I used to go to buyer's agent seminars. I used to read books about property investing. And I used to also buy Your Investment Property magazine. I don't know whether it's your or my investment property magazine. I forget now. And at the end of the magazine, you had a snapshot for each month, for that month, about the stock on market, days on market, etc. And I used to ask myself, okay, it's good to know what the current levels of stock are, but I don't know whether it's trending down or up historically, which means that I can't make a decision upon that isolated view. The wider the view you have of the market, the more trend you have, the better it is for you to understand what is going to happen in the future. So this is why stock on market long-term slope. Now, there are certain intricacies about how we develop metrics, what they are, etc., which is could be a bit confusing to people who are first listening to it for the first time. But less than zero, just imagine what I did there. Zero is the equilibrium line, meaning that there's stock equilibrium in a suburb, stock on market. By setting it less than zero, I'm saying to the data set, please list all of the suburbs that in the last 5 years have a stock on market that's trending down, i.e. increasing supply scarcity. So we need to establish supply scarcity with the supply side. The less property that, and this is how everything gets connected. If I establish supply scarcity, meaning there's not enough property to purchase in an area that has very high levels of affordability and also less risk, I'm creating a perfect storm. Okay. So we set it at less than zero, meaning decreasing. The next thing that I do, and this relates back, coming back to the historical representation of supply. Inventory is also referred to in some circles as the absorption rate. And it allows you to peek into the past essentially to see how historical levels of supply compare to the levels now. And if they're trending down in unison with stock on market, again, you're compounding good decision making. You're ensuring that there's supply scarcity within that area. So in the same way, we set that at zero as well. Now, guys, I can see that on the screen, you have some areas there. I've for the last 8 years, and I do strategy sessions. I coach large buyers agencies. I have about 3 or 4 a day sometimes. Okay, and I can tell you this: disregard names. Let the data speak for itself. Let the narrative speak for itself. Because if you get attracted to a name of a suburb or location, you're inadvertently going to be guided by bias. I'll tell you a story. Now, everyone has a different opinion and it suits a different brief. And I need to say that caveat before I move forward. About a year ago, Durack in Darwin was coming up in the shortlist. Now, that area, Darwin, again, disregard the misconceptions and biases. It was fitting perfectly into a filtering algorithm, okay, for a short-term equity extraction timeframe. Okay, it's not a good, just as a caveat, it's, in my view, it's not a good long-term investment location. But I'm just giving you for the short term, it was coming up. Anyway, because it was in Darwin, okay, I used to put it to the side. So I did exactly what I tell our members to do. Why? Because I'm human. We all get driven by bias. And we see that in those areas, property has grown 100K within 2.5 months now, okay? So anyway, putting that aside, what I'm trying to say is that let the data speak. Don't get attracted by the names in the shortlist, okay? And these names that are in the shortlist might not be suiting your brief anyway. So the next thing that I do, coming back to supply, remember, we address the current levels of supply. We address the historical levels of supply in comparison to current. Now we have to address short-term future levels of supply of new dwellings. Okay, and this is especially important if your equity extraction timeframe or a growth target of 20 or 30% needs to be realized within the next 2 years. Why? Because the levels of current building approvals will take about 2 years to materialize into a dwelling. Okay, that's the development cycle. And imagine you invest in an area that has an exorbitant amount of current building approvals, which means that they will turn into stock on market 2 years into the future, right at the time when you need to extract equity. Now, this brings me to the equation. Property growth, price and property values, it's a very simple equation. Reducing supply, increasing demand equals price growth, okay? So if your supply is increasing 2 years into the future, you would need sufficient demand to absorb it to not see price decline. But we don't want to dabble in that. We want to make sure that we restrict it. We want to make sure that the area that we're investing into has lower levels of building approvals now to avoid messing up our growth patterns in the future. Yeah. So I choose the building approval ratio. Where is it? Building approval ratio. I set it at less than 1.5%, for example. You can set it at 1% as well. As I said before, guys, refer to our data dictionary and the ranges. Some of you probably know, maybe all of you, and apologies, I'm speaking out of turn. All right, last thing that we do for supply, we need to address future levels of supply of existing dwellings, long-term future supply. And there's a beautiful metric called hold periods for that. And I love that metric personally. Why? Because it has a dual meaning to it. The first one is it's a livability metric. Think about it this way. The longer people hold on to their assets in a particular area, inadvertently means that they want to reside there. And there is a reason then for it, okay? Now, it's also a supply metric because if every 7 years, for example, residents of an area start disposing their assets, that means that every 7 years we see an influx of supply, which again, if not met with the appropriate demand, could diminish price growth, okay? Now, when it comes to hold periods, it is very rare. Let's say you have an asset hold time frame of 10 years. I wouldn't, in your instance, come and set the hold periods at greater than equal to 10 to avoid any influx while you're holding the asset. Why? Because on average, it is very rare, I guess, for a suburb in Australia to have a hold period of 11 or 12 years. Yeah. So what I do in this instance, I at least set it at the bottom end of one property cycle. And the general consensus is that property cycle, the macro cycle, mini cycles are different. That property cycle lasts anywhere between 7 to 10 years. So again, to cast a wider net, but to set the bottom end boundary, I set the hold periods at greater than equal to 7. Okay. Now, what do we have, guys, up to this state? What is this filtering algorithm? This filtering algorithm answers the following question: budget, long-term investment time horizon. It still doesn't address equity extraction time frame. That's the last metric they'll insert. And it addresses low risk profile. Okay. So what do we have? We have very low levels of volatility, i.e. an area with low risk. Okay. We have very high levels of affordability, and we have supply scarcity at different timeframes. It's essentially a perfect storm. You're 80% there. Okay. Now, the last metric that I usually use is a proxy for market cycle delineation. And this brings me back to the warm spot, hot spot methodology. Now, what are warm spots? Warm spots are areas that have very high levels of affordability, low risk, severe supply scarcity, and a flat demand, long-term, but short-term, improving demand, okay? Increasing demand, if you will. Long-term flat, but short-term increasing. Those are areas that are gaining or starting to gain some momentum now and will achieve a growth target of 30 to 40% 4 years into the future or thereabouts, depending on the alignment of metrics and the trends, okay? And usually warm spots, they usually see about 0 to 5% growth in the last year. And that corresponds to on-the-ground behavior. Now, in warm spots, you usually see 2 people competing for the same asset, maybe 3, okay? It can go sometimes even to more, and in certain instances, Melbourne is a good example, but Melbourne's growth still hasn't caught up to reflect a hotspot. Now, you also have transitioning areas that are transitioning between warm spots and hotspots. And those areas usually generate anywhere between 5 to 10% growth in the last year. And they have an equity extraction timeframe of 3 years, i.e. a growth target of 20 to 30% within that timeframe of 3 years. And then you have hotspots, okay? Hotspots are areas that are seeing anywhere above 10% growth in the last year. So it can be 15, 20, or 30, okay? And when it comes to on-the-ground behavior, even 10% plus growth means that you're getting 15 offers for the same house. And this brings me back to, if you have an equity extraction timeframe, you need to invest in of 2 years, meaning you need to generate 30% in 2 years. You need to invest in a hotspot, but the con of that is that it's going to make it harder for you to source an asset. And that's something that you have to understand, which means that you either need to readjust your brief, i.e. you move it up the stream and invest in warm spots, meaning you're going to sit on the sidelines for 4 years to generate the growth target, or you speak to sales agents, you establish good connections with sales agents so you can get right of passage, I guess, so they can answer your phone calls, send you deals that are off market, et cetera, et cetera. And I think that's a very important thing to remember. If you want to invest in property, relationships are very important. You need to communicate with sales agents. Not only that, you also need to deliver on your promises, okay? You can't burn bridges. So sometimes you'll even do a deal where a little bit disadvantages you in order to produce a semi-win-win solution. But I digress. So let's assume that we want to invest in a warm spot. And warm spot is usually a methodology that's employed when we are anticipating market movements. Okay. So I have 9 more minutes or 5 more minutes. I'll just speak about this and I can take questions. And I'll need to mention one more last thing after this as well. So warm spots are usually used to anticipate market movements. So because warm spots allow you to enter an area where you can source the asset, you sit on the sidelines, there's not too much competition. And if you nail the warm spot and if you align the metrics perfectly, it is nearly guaranteeing to be a hotspot. Okay. I mean, in the last 8 years, using this methodology, we've never missed a hotspot. When everyone was talking about Perth, we had Melbourne as a warm spot. When everyone was talking about Perth in 2023, Townsville was appearing on the shortlist of warm spots, although it was growing a little bit more, probably like a transitioning area. But anyway, no, not a lot of people were looking there. Mainly the purchasing was executed by owner occupiers. Yeah. So in order to delineate market cycle position, I include the last metric, which is only a proxy. Now it's not a direct correlation. It's just a proxy. So I use the price change in the last year and I say, okay, between, as I said, 0 to 5, those are warm spots. Yeah. Now we are nearly 80% there and I have only a couple of minutes and I do want to mention something. This is stage 2, building a filtering algorithm that relates back to your brief. Then there is a stage 3. And stage 3 mainly relates to question number 5. Are you in the acquisition or expansion phase, or are you in the consolidation phase? Okay. Are you focusing primarily on capital growth, or are you focusing primarily on cash flow? Okay. And deciding that then gives you insight into what significance you need to assign to metrics to do a detailed comparison. Nothing in isolation has meaning. Okay. That's very important. Nothing in isolation has meaning. You cannot look at an area, and I get a lot of these requests. I say, what do you think about area A? And I always say, in comparison to what? Nothing is meaningful in isolation, which means that everything needs to be compared, which means that you need to do a detailed comparison across 10, 15, 20, 30, 50, 100 metrics in order to arrive at a result that has minimal opportunity cost. And we have on the platform something that's called a DEX comparison module. I mean, I can do another session on this. It could go for an hour or 3, but just imagine that it allows you to not only consider a hierarchy of metrics, you see level 2, level 3, level 1 being the most important, but you also have a timestamp associated with metrics, i.e. you can lay a level 1 short-term, level 1 mid-term, level 1 long-term, and then you go level 2 short-term, mid-term, long-term, level 3. And that way you create a very, very robust comparison that is close to guarantee you the outcome. Okay, that's it. I try to compress as much as I can,
and you did your best.
I don't know whether I hope.
All right. Let's not waste. All right, we got some questions. Question number 1 is BA ratio, which I assume would be building approval ratio. Is it annually, monthly, or quarterly? Thanks.
Everything is reported monthly. Data is refreshed at the end of each month, essentially midnight, last day.
Awesome. That answers that question. Question number 2 is, okay, you ready for this one, Matt?
I'm ready, mate.
Yeah. Why is HtAG and domain showing different DOM for Suburbs, which I believe days on market?
Yeah, okay. That's a complex, because we develop our own methodologies for reporting mechanisms. Okay. Now, these methodologies are developed for accuracy. Now, if you guys need to understand our methodology, why we built it and how we built it, we have on Mastermind a data FAQ section. And one thing that I have to really, really mention here, and it's a great question, I avoid triangulating platforms, comparing one platform to another, because in order for you to understand how to compare apples for apples, you need to understand the methodology of how that data is recorded, okay, for a particular provider. And if you're looking at days on market, or I don't know, usually the issue is vacancy rate. Why does SQM report this and HtAG the other thing? Well, SQM, I think, doesn't report it monthly. Okay, I think so. SQM reports it per postcode, not suburb. I think so that as well. So there are numerous instances, because in a postcode you can have numerous suburbs. We report everything per suburb. So in order for you to understand and compare platforms, you need to understand respective methodologies, and that's going to be very difficult. However, we publish ours on Mastermind regarding everything. So regarding days on market, vacancy rate, stock on market, literally everything. On our platform, we have 150 metrics. I would say 60% of them have been exclusively developed by HtAG, and the intent is accuracy, not to, be a cool kid and try to be different. It's just the accuracy is the main reason.
Okay, and the other question is, what's the maximum affordability you have seen if some spots in Melbourne, say for example, with a 45 score grow anymore, their affordability will be so bad?
Yeah, I sort of understand the question. Okay, as I do always, I answer everything in a roundabout way, and then I provide a summary. So think about affordability as a purchasing friction point. Okay, so, and it's related to the price point. Let me give you an area, Dallas in Victoria, which by some is taunted as a good investment location. Now, I don't want to sound egotistic now. I can see the way I'm waving my head. I look like my teacher. But what I'm trying to say is that Dallas has an affordability index of 50 for a price point that's 550 or 600. While remember how I said compared it to other areas that have very similar metric have an affordability index of 30, which means that in other areas it takes 20 years less to pay off a home. Now, will Dallas grow? Yes, it will grow, but the growth will slow until it reaches that inflection point where it can't grow anymore because people can't afford it. And that relates back to the notion of steam. So affordability index is a great way to determine steam, which is why you need to start from the bottom end, and it's an all time frame metric. So it works for all time frames, short term, mid term, and long term, which means that if you have the arrangement of metrics appropriate, and then you have very high levels of affordability, i.e. you're starting from a very low 20 years to own index, that means that that area has steam for much longer than an area that's beginning at an index of 65. Now, the area A that's starting lower has a much higher probability that it has more steam than area B. Okay. Now let me give you another I would say tip. You have thresholds for metrics. Another one is socioeconomics. There is 0% chance that an area that's 700K in value will double in a decade with socioeconomic score of 1 and 2. Means disadvantageous. ERSAT of 1 and 2. ERSAT is a score from 1 to 10. Yeah. So there is 0% chance, and you can look at any data set. So what I'm trying to say is that, let's say you buy in an area that's 700K and it has an ERSAT score of 1 and 2. Yes, the area will grow, but the more it grows, the more it starts hitting a friction point. Think about an elastic band. When you stretch it until your physical constitution can't hold it anymore, it compresses back. It is the same with the affordability index. Now, I hope I answered the question.
Yes, you have. And there's another question that, please, can you share the link you mentioned initially? If you can please share that link with me, Matt, and I'll share that with
the affordability index chart.
And the FAQs as well.
FAQ, yeah, our data dictionary. Yeah, no worries.
Yes, 100%. So, hey, listen, thank you, Matt. That was brilliant. And look, you have taken what's often overwhelming and turned it into something clear, actionable, and actually exciting. Now, guys, I'm sure everyone over here is walking away with fresh perspective on how to spot opportunities before the market catches on. Now, quick recap. We talked about how to ensure to ask those 5 questions that Matt discussed. We spoke about macro and micro matrices. We spoke about supply and demand. Why most investors miss the mark and how not to be one of them, and how to move from passive research to more strategic and have some confident actions. Now, what happens next from here? We will have a list of suburbs, and you can send your request of suburbs to Property Dollar, and you can send it at info@propertydollar.com.au, and we can look at the request for you to buy that list, buy that report that is being generated by HtAG.
Sorry, Raul. I was about to say, sorry, guys. I forgot. Yeah. So Yeah, Property Dollar has access to our reports. If you guys want to have a look at that, you can inquire with Property Dollar, and in there you will get essentially all of the metrics as well as their explanation and ranges. So I think it's very useful for you, especially if you're trying to make a decision now.
Awesome, awesome. And in addition to that, all the Property Dollar users, if you like all this data analytics and you like the way the prop tech is going forward with how we analyze suburbs, etc., and if you're ready to apply this to your own situation, we are offering a free one-on-one strategy session to personalize everything you learned today for Property Dollar users only. Now, the advice would be tailored to your goals, your numbers, and your next step. This will be covered for Property Dollar users only for free. Now, we will send you a recording of this webinar, of course, and you can reply back to that email with your details, and we will ensure that we'll set up something with you. Make sure you download Property Dollar before that. Also, if you haven't, please fill out the quick poll before you log off. It helps us better to understand where you are at your journey, and it helps us better to help you. With that, thank you so much, everyone. Thank you, Matt.
Thank you, guys. Appreciate it, Raul.